QuickBooks Pro Desktop 2021 apply customer deposit credit to an invoice. In other words, in a prior presentation, we recorded a customer deposit, a deposit for a sale we will make in the future, a down payment for a guitar in our case. Now we're going to record the invoice and apply that deposit, that prepayment from the customer to it. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage practice file. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown and selecting the Open Windows list. We're going to be recording an invoice, but it'll be a bit different this time because we'll be applying a credit or a customer deposit or a customer advanced payment to the invoice. And that advanced payment is something that we recorded in a prior presentation. If you didn't see that prior presentation, we will recap the process, but I do recommend going back and taking a look at that prior presentation. So in our situation, note that the normal process or flow would be here indicated by the arrows. You create an invoice, then we're going to receive the payment at a future point, and then we're going to deposit that to the bank. If we get a payment before we do the work, in our case, we're talking about a fact that we have a fairly large item that we're selling, a guitar. If we don't have it on hand, but we promise to buy it from our vendor for the customer, we then ask for a prepayment from the customer. In that case, we have a partial payment. We've received money from a customer before we did the work. So in essence, you kind of have this second button happening before the first item happens. And we actually record it with the received payment, or we did so. That works logistically well. Let's review where we are on the trial balance there on the balance sheet. Let's go to the reports dropdown, go to the company and financial, down to the balance sheet standard. We're going to be changing the dates in the custom reports on the upper left to 01/01/21 to 12/31/21, January through December 2021. And we'll see that when we entered that, we actually ended up with a receivable, double-clicking on the receivable, and this negative amount in the receivable. Now that would be normal if we were applying that to an invoice, but here, that negative amount didn't get applied to any invoice. And if I double-click on it, you'll note that there's no invoice down here representing the payment that has taken place that it ties to. So that's unusual. If I close this back out and close this back out, let's take a look at the sub-ledger account by going to the reports dropdown, going to the customer and vendors, and take a look at the customer balance detail report. And here is that the customer is Anderson Guitars. You'll see that 250. Notice it's a negative number here. That's weird because that would seem like we owe Anderson Guitar money. That's true. And we do owe them money because they gave us money in advance, a down payment, and we didn't give them anything yet. We're going to give them a guitar, but until we give them the guitar, we owe them the money back at that point in time. So we either owe them $250 back, or we owe them the completion of the work we promised to do, which in our case is to finish the guitar. Once we get the guitar finished, which is what we'll do now, we can apply the invoice or add an invoice here and tie this $250 to the invoice, which is what we're going to do. But in time frame, it's backwards. Now, before we do that, if I go, notice that this total amount in the receivables is now basically understated, because really this $250 shouldn't be a negative receivable, but it should be a liability. So we talked about if I go back to the balance sheet, this number is understated and we should have a liability called like unearned revenue. Is that a problem? Well, for us, it's not a problem if we adjust it before the end of the time period, before we have to present our financial statements. Then it's not a problem, because once we enter the invoice, it'll net out like it normally should. It's just a timing difference. The timing difference will have ended and our accounts receivable will be back where it should be, no problem. However, if we were to, and we'll see this when we do our adjusting entry, still have an outstanding process where our accounts receivable were understated and we had not yet finished the invoicing process by the end of the year in our case, or the end of the month, then we'd have to do an adjusting entry, basically increasing the accounts receivable and recording the liability to represent fairly our financial statements. So that's where we stand at this point in time. Logistically, this works really well because we want to use the subsidiary ledger, which we cannot do for a liability account, to tie out these items, which will be the payments and the invoices, which we will do now. I'm going to create an invoice, which will then match out this 250, applying the credit memo that is represented by this negative 250 to it. So let's go to the home page then. And so now we've entered this sales receipt first. Now we're kind of going backwards on the arrow thing here and going to the create invoice. So we're going to create an invoice, and we're going to create it for that Anderson Guitars. That's the customer that has that outstanding amount. So we're imagining here that, you know, they needed the guitar for whatever reason. We didn't have the guitar on hand when they wanted it. We said we're going to go get it. Possibly in practice, that would mean you'd have to go to pick up the guitar, right? You'd have to buy it possibly from your vendor, and now we have it. And so now we're going to tell the customer, we're going to bill the customer and say, hey, pick up your guitar here. We've got it, and you can finish off the payment at this point. So we're going to say this is as of the 18th. So let's pick it up as of the 18th, and invoice number 5. PO number, and none there. There's no purchase order number. And then, because we're not linking it to a purchase order terms, is going to be the net 30. That's correct. And the item we're going to sell is a Gibson USA. So a GI-USA is the item we're selling. We're going to sell one of them. So there it is. Now that cost the $380. So $380 plus the tax. $399. I'm gonna remove the sending of the email. We want to apply the credit to it now. So I'm gonna go up top in the main. So I'm in the main section, the main menu section, and select the apply credits. And the changes in this form must be recorded before. So I'm gonna say, yeah, go ahead and save the changes beforehand. And then here's the credit that we have. So there's that advance payment of the $250. So that's the available credit. That's the only one that's available. That's the only one we have here. That's the advance payment that we got before we issued the invoice to kind of lock them in to the sales process. So we're going to say done, and there we have it. So there's going to be the $250. So what's going to happen when we record this? We're going to say, all right, it's going to be the same process. It's an invoice, so the accounts receivable is going to go up. The accounts receivable is going to go up by the full amount, the $399, but it's going to be netting against that $250. So that $250 is that negative balance that's on the receivable. So the receivable is going to show the invoice at the $399, but it will then net out the $250, which was already on the account for Anderson, giving us an increase of what Anderson owes us after that point of the $149. So again, it's going to increase by the $399. The credit, it has already been basically recorded. It's already in the subledger. And then the other side, of course, is going to go to sales. That's for the $380. The difference between the sales and the accounts receivable, the $19 is sales tax. That's going to increase the payable that we owe to the government. And then we see that the inventory is going to go down by the cost of the Gibson, which is not a number that's recorded on the invoice, but it's driven by the item here. So, and then we see the cost of goods sold. We will see the cost of goods sold will be going up for that same cost. Once again, not on the invoice, but driven and known by the computer through the item. So let's go ahead and save that. So I'm going to say save and close. And then if I go to the balance sheet, our major thing that we're looking at, the new thing here, if we go to the accounts receivable, we see that we should have, if I double click on this item, we have the invoice down here, and then the deposit was already recorded. So the invoice increased the AR by the $399, the full amount. If I double click on that, notice you might think that it would increase by the $149. No, it increased by the full amount because the $250 was already in the receivable. So closing this back out, the $250 is already there. We're just tying it out to that particular invoice. Closing that back out. If you look at the customer balance detail, we'll see the same kind of summary information. Now we have the invoice and the payment that are tied together. These two are netting out. They're kind of tied together now, even though they're in reverse order than you would expect normally, meaning normally you have the invoice and then the payment. Now we have the payment, but less than the invoice, then the invoice, and we're going to get the rest of the payment in the future. The total here at the 8710 ties out to then the amount that's going to be on the balance sheet. Now, then the rest of it's just normal invoicing kind of process. The other side of this is going to be on the profit and loss. If I go to the reports drop down, company and financial, P&L, profit and loss, income statement, changing the dates, 01/01/21 to 12/31/21. We're going to see the sales increasing by that 380. That's going to be the amount not including the sales tax. The difference between this amount and the amount that increased the accounts receivable is going to be the payable of that $19. If we go back to the balance sheet, we'll see an increase in a payable or liability account, which is a liability account, the sales tax payable here for that $19. So there's the 19. We also know that the inventory, closing this back out, is going to go down. So inventory is going to be decreasing. Double clicking on the inventory, it's going down by that 304. Double clicking on that item, it's not something that's on the invoice, but the computer knows about it and records it on a perpetual system using the items that we set up in the past. So closing this back out, the other side of that will of course be on the profit and loss again. And that's going to be under the cost of goods sold, representing the expense of us consuming the asset, the inventory, in order to generate the revenue. There's the 304 once again. So closing this back out, just to review what we have so you can track where we are at this point. If you're following along, want to check your numbers, here's where we are in terms of the balance sheet and the profit and loss. Here's where we are in terms of the profit and loss. If you want to check this as easy as possible, I think the trial balance is the best one to use. Reports drop down to get there. Accounts and taxes, trial balance. Changing the dates up top from 01/01/21 to 12/31/21. Here's where we stand in terms of our trial balance at this point in the practice problem.